Thanks a lot, Prashant. I'll request everybody to type in their questions in the chat box at the bottom of your screens. So, Prashant, while the questions come up, there is, as we've been talking about the emerging market strategy with clients, one question we've received quite often is about China. China being a significant part of the emerging market basket, and with a lot of macro headwinds that there could be there. Just your thoughts on that from the investment in China.
See, obviously, over the last 20 years or plus, or always, I would say, there are always headwinds in every market from time to time and tailwinds from time to time. I've had in June 2020, so right after COVID, we've hardly seen outflows, touchwood, from India by foreign investors, at least talking about WhiteOak. But June 2020 was the highest outflow. Couple of very long-standing investors and believers in India exited because they said there are major headwinds for India. India is not going to be able to deal with COVID. It is chaos. This migrant crisis was there and whatnot. Whereas look at China, despite the virus originating there, they've got it under control. The whole world is reeling under COVID virus, whereas China had it in control. So we are moving the money from India to China. So China was the favorite investment destination mid-2020, I think safe to say, amongst emerging markets or anywhere globally. And then 2 years later, it turned out to be the worst destination in people's mind. So these things come and go. 6 months ago, there were a lot of people asking us to launch GEM ex-China strategy, because China was down 50% from its peak in 21. Today, I don't think anybody's interested in, or far fewer, a fraction of those people would be interested in GEM ex-China, because China is up 40% or something from the bottom, and people are seeking China exposure, whatever reason, because it's underperformed, because now COVID zero has gone away, so it's reopening. So China normalization story. So all these stories are made after the market moves. And I don't believe that, investment decisions should be made based, or we've discussed this oftentimes, but when you make investment decisions based on what you see going on in the macro environment on the day and reading the newspaper and social media, that's not going to, have much value in terms of performance generation in our view. So yes, we intelligently seek to mitigate the risk. As I shared with you, we have greater exposure to Chinese consumer through companies like LVMH and Hermes and so on. But China remains the largest EM country, and you cannot ignore it, in my view.
Sure, Prashant. Thanks. Actually, keeping in, talking about flows, there's a question on FIS flows, which was, as we all know, stopped or there was a lot of outflows last year from emerging markets. What's the impact like of that this year? Could the markets and the portfolio go further down in absence of FI flows?
Sorry, I could not follow the question. Can you repeat that?
Sorry, yeah, Prashant. Basically, the question FI flows, we saw some bit of outflows last year. What would the flows be like this year? And in absence of positive FI flows, could that impact the markets?
So see, FIIs are no longer as important as they were believed. So even back when they were believed to be super important, I never believed that they're that important. And today, if you look at I'll just open up the slide here. If you look at the numbers, they themselves show that they're not that important anymore. So if you see here, last year, I'm just going to take the pen, FIIs had the very worst year, -17. I mean, it was the worst year of FII flows at -17%. -$17 billion. It was worse than 2008. Obviously, as a percentage of market cap, it wasn't as bad as 2008. But the inflows in India have been quite strong. It was the best year of inflows in India by absolute dollar terms. So Indian amounts have become far larger, as I think is well known now, 20-25 billion dollars kind of range compared to FII flows. Whereas if you look at before 2014, the Indian flows were very small, whereas the FII flows before 2014 were quite dominant over here. And that has flipped now post 2014. So I think FII flows, first of all, they are impossible to predict. The only thing I can say is if markets do very well, there would be positive flows. If markets do very poorly, there could be negative flows. It's not that the FII flows determine whether the market goes up or down. It's the other way around. If markets go up, FIIs would come in. If markets go down, FIIs would exit, just like retail investors in India. They would also scale back or might even go negative if there's a sharp downturn, as was the case with, hold on, I'll just show, as was the case in 2010, 2012, 13, when markets were down, there were outflows from Indian investors as well. So back to you, Vivek.
Sure, Prashant, thanks. I think there are a lot of questions on the emerging markets fund and how to invest and what is the minimum requirement. Maybe Prashant, I'll answer that that part of the question. So the emerging markets fund ex India is a UCITS fund which is domiciled in Dublin and is managed by WhiteOak Singapore. The best way to invest in emerging markets fund for resident individual investors is through the LRS route. The LRS route permits you to remit $250,000 each year for investments outside India. So we have an office based in Singapore who would help getting the investment through. We've also onboarded the fund in with some of the private bankers in India, and they would also be able to facilitate the investment. The minimum amount required is $25,000 for investment, and it is open to all resident Indian investors investing overseas. It's also available for investors who are based outside India and want to invest in a dollar-denominated product as part of their overall portfolio. In terms of the documentation, etc., it's relatively straightforward. You just need a identity proof and an address proof, and fill out a subsequent document through which we can then make that investment. It is very similar to a mutual fund in the way it operates. It's unitized. It has daily liquidity. You can invest and exit on any day of your choice. And happy to answer specific questions separately on how to invest in the fund. So maybe Parag, there's a question for you on the Indian financial sector and how do you see it performing in the next 1 or 2 years, and any specific risks which you might want to highlight.
See both on the financial sector as such, you can divide into two parts, lending, non-lending. I think, on both the side, the banks, NBFCs are doing quite well. If you look at all the parameters of the, lending companies, whether it is loan growth, whether it is margin, whether it is asset quality, I think on all three parameters, which are, predominantly more important, on all these three aspects, our banks as well as the NBFCs, what we own, it's doing quite fine. And I think, same trend is expected to continue. We don't see, much impact on growth. There will be some, cyclical, downturn to the margins, it happens arithmetically. But otherwise, as we head for next 1 or 2 years, I think lending financials should be very, very fine. On the non-lending side, there has been some changes on the insurance, especially life insurance from the budget. To that extent, what we think is there could be some reset in terms of business prospect for 24 and 25. But I think the opportunity for the long term for the life as well as non-life sector remains very promising. So, there also we believe that the business as well as the stock should do relatively very well. Vivek?
Sure. Thanks, Parag. And maybe Rohit, the quick question on the consumer sector from you? Again, the opportunity next few years, any risks that you see?
Sorry, this is opportunities in the next few years, right?
Yes, Rohit.
I think Indian, the overall consumption space, when you look at consumption in India, it's not just the next few years. I think this is going to remain a growth sector for the next few decades, maybe. Right now, the key really is what categories will grow, which companies will do well. That's really where opportunities will come as a overall pack, right? If you look at private final consumption expenditure, that's about 58-60%, right, of our GDP, right? India is a domestic consumption story in some sense, right? Now within that, there are of course various dimensions, cuts that you can look at: staples versus discretionary, urban, rural, right? SEC, class. So what consumer categories, what do they consume? How will each of those segments of the market evolve? And on a bottom-up basis, you take a call on which are the best opportunity segments and companies therein. Now, there's perhaps a burning question on everybody's mind in terms of whether we are seeing a consumption slowdown and how do we read that. Now, again, while this is a multi-decade growth story, there will always be some phases where consumption growth will slow down. It's an upward sloping curve, but with variations. You'll have a sinusoidal wave, right, where growth rates will fluctuate, right? And what we have seen in the last 1.5 years is, of course, the households have had to adjust their budgets to rising inflation, right, in their consumption items, monthly consumption basket, as also with rising interest rates. Some of your EMI commitments, etc., they go up. So overall, there is some pressure on disposable income. There are adjustments that households and individuals are making, some more than others. That is the case-shaped, recovery and impact that we've been hearing about, and that has started reflecting in some slowdown in consumption growth. But these phases are not new. These phases are going to happen, every few years. But the long-term consumption story is intact. Has to be played on a bottom-up basis, looking at segments and companies.
Sure, thanks. So Prashant, back to you. So there is a question on what do you think could be 2 or 3 reasons which at all might derail the India growth story in the next 2 or 3 years, or the risks to the Indian markets?
So obviously there are a lot of known risks. Like if globally things were to collapse, then obviously India is not insulated, and this is perennially always a relevant risk. Nobody knew something like COVID were to happen. Nobody knew that Russia would be invading Ukraine, till these things. So these are unknown risks which can happen anytime. If for whatever reason inflation were to spike again, so it has been on a declining trend globally over the last 6 odd months at least. If for whatever reason, let's say worsening of the war situation, Russia, Ukraine, some bomb gets dropped somewhere and that prompts disruption or supply shock, and if there is inflation, that could have global impact as well as on India. Importantly, in India, there is a central election coming up next May, in about 15 months' time. Now, everyone believes there would be a favorable outcome for the market, but in politics, you can never predict and never be 100% sure. The market has now liked continuity historically. And if that were to continue, that's well and good. But otherwise, if there are any negative developments on that front, then market may react because it would be something that is unexpected from market's perspective. Obviously, you can paint any dire situation, on a geopolitical front and whatnot, but you have to think of what is the probability of those events. So no point in like China-India conflict. Now, what is the probability? Those things. So the probability that there is already factored in the market. We don't have any special insight where we believe certain macro event is, and nobody has these insights. People who believe they have insight don't have a clue that they don't have an insight. We just are aware that nobody has an insight on any such macro development, which the market is not anticipated with appropriate probability, and others have. There are no such things. Obviously, all these macro developments, market has already incorporated them to their probabilistic level. So there is a certain probability that inflation can spike up again. Market has already been reflecting, is reflecting that probability. But what market is reflecting is the probability, not the event. So if something has 25%, let's say when you roll a dice, 1, 2, 3, 4, 5, 6, the probability of 2 coming up is 1 in 6. But if 2 comes, that becomes 100%, right? So if something like that were to happen, it is not to say that market would not go down. Market may go down, but whatever is a appropriate, reasonable probability of such a thing happening has already been factored in by the market at this time. So if inflation, so on the other hand, if inflation were to continue to go down and hence Fed stops raising interest rates and whatnot, markets may rally in the US and in India and elsewhere globally. So that's how I would pose the biggest uncertainty at this time would be from an India specific perspective, the elections in 15 months time.
Sure, Prashant, thanks. And just as a follow-up to that, there's a question, and this I know you answered many times in the past, is what is the expected returns from the market?
So there are, I know there are a lot of questions here that I can see, and I don't think we'll be able to get to each one of those questions today. Maybe some of them they can follow up with you, Vivek, and we can answer. And this question, there are other questions about number of names in the portfolio and the mutual fund versus PMS, just glancing through it seems, and numerous ones, and the others about emerging market fund, the way and all that you explained already, but there's some other questions. So maybe those questions can come to you at a later point and maybe you can address. But on this question, because these are questions we've addressed large number of times, and for a lot of our audience who are regular audience and join every time, it may be very repetitive. So maybe if there are other questions which are more first time, maybe we address them more so. But on this specific question, what are return expectations? Return expectations in any market, what is logical return expectation over a longer period of time? The same should be the return expectation over a short period of time. It may materialize, may not materialize over long term or short term, but those are the logical expectations. So for India and for globally in any market, a reasonable expectation of return is in line with nominal GDP of that country in local currency terms plus the dividend yield. So that's the graph that I'm glad Dipojal you has brought up. So you'll see, and this is true in US as well, over a very long time period, the returns are in line with nominal GDP plus dividend yield. So in India, nominal GDP growth rate over the last 30 years has been 12%, 12.4. Sensex EPS growth has been 12.2. And rupee return has been 12%. I mean, very close to each other. It should, theoretically, it should have been 13% because, or 13.25% or something, because you add the dividend yield. But obviously, multiple compression might have taken place because in FY 93, we were just coming off of Harshad Mehta scam where multiples were very, very high. So that might have knocked off 0.5%, 1 percentage point. But on an ex-ante basis going forward, if you assume Indian economy in nominal terms can grow 10% or so, roughly half in 4 to 5% inflation, call it 5 to 6% real GDP growth rate. 5 sounds low, but I'm talking about over the next 10, 20 years, then a 10% nominal GDP growth rate seems reasonable expectation, and 1% dividend yield. So 11%, 10 to 12%, call it, expectation of return from the market seem reasonable going forward. A tad lower than historical past because the GDP deflator is likely to be a tad lower than historically.
Sure, Prashant.
Obviously, active managers
like
ourselves, hope to and expect to do better than that as we have historically done.
Prashant, this is just another question on China, and I'll ask this: with China opening up again, does India's projection to be the leading manufacturing hub in the world still continue?
Yes, so obviously, if the China, so there's a lot of talk of late amongst investors and amongst investors and corporates about the China plus one opportunity. So there is a structural element to that has been ongoing since even pre-COVID, because of combination of reasons. Because I mean, when Trump got elected, even before that, there was this ongoing desire for diversification of supply chain in Fortune 1000 companies around the world, or any corporate around the world. Nobody wants entire dependency on China. But if you look at COVID and the supply chain disruptions that were caused by COVID, those were board level decisions that, look, we can no longer afford going forward to be completely dependent on one country in our supply chain. Yeah, most boards would. So just because COVID reopening has happened doesn't mean that these boards would say, okay, it is a thing of the past and we no longer need to worry about supply chain. The COVID event has drove home the importance of supply chain diversification. The Russia-Ukraine event has drove home the importance of supply chain diversification. If someone was, and there are European companies who were dependent on Russia for a lot of their supply of variety of inputs, with the sanctions and all on Russia, their business model came under extreme strain. So with geopolitical tensions between China and Taiwan, remember, all these companies around the world, they have to do business continuity planning, in which they plan for things like terrorist attack, earthquake, hurricanes, whatnot, in place of doing business. So all 1% or low probability also they have to plan for. And similarly, with the geopolitical issues and the COVID pandemic issues and the Trump issue over the last 4, 5, 6 years, what has been driven home is the need for supply chain diversification. Yes, COVID zero, behind us, maybe that has on the margin reduced the sense of urgency, but directionally, we expect that to continue. India will be one of the beneficiaries unless India screws it up ourselves. We already doing business in India is much better. I mean, ease of doing business is much improved over the last 10 years, but still India is 63rd, right? So there's 62 other countries where it's easier to do business than in India. And a lot of the business coming out of China would go to a lot of those countries from the 62 countries. But India needs to continue to make it easy for people to do business. If we make it, for whatever reason, go back and make it more difficult, then that would be a bigger risk to the China plus one story than what's any COVID reopening or shutdown.
Sure, Prashant.
With the production linked initiatives and other initiatives from the government, I'm not saying that's what's happening right now, but I'm just saying that is a risk to watch out for. But otherwise, I think the benefits to the manufacturing sector can last for a fairly long time of the China plus one.
Sure, Prashant, thanks. Maybe one question for Parag, from linked to the budget and the impact on the insurance companies with what was spoken at the budget, Parag.
Yeah, so see, especially for life insurance, in India, insurance is all about, one is the saving component and second is the protection component. And over a period, if you look at always the saving dominated the life insurance portion. And there has been changes there that, if you shift to a new tax regime now, then the tax benefit on the life insurance premium, which you used to get, may not be available. So that's one change. And second change is, of course, the for more than 5 lakh rupees ticket size, there will be so receipt, or you can say the maturity amount of insurance would be taxable. So when you look at those two changes, of course, the saving portion of the business will get a hit for all the life insurance company. The impact would be anywhere between 5 to 12, 15% on the revenue or a AP, as you call, for life insurance companies. The profitability impact would be little lower because many of such policies are one time in nature or a single premium where the margins are generally lower than the overall company margins. But net, as I also said previously, there will be a reset of a saving business component of a life insurance companies. It would be more streamlined. I think the companies which will do after the reset very well would, somebody who has a very wide breadth across the channels, have multiple product lines, So all those companies will do very well over, let's say, next 3 to 5 years. But of course, for FY24, or you can say immediately next year, there will be some impact on life insurance companies.
I see a lot of questions on Hindenburg report as well. I think we'll refrain from going in too much details of that. But as far as the market is concerned, we think at a broader level, the effect is largely behind us. Yes, there was very heightened concern amongst investors, global investors, foreign investors, within the 5 to 10 days following the report. But as of now, I think foreign investors have also understood it's a very limited impact, a narrow impact on a set of companies, and the kind of things that Hindenburg report says has no bearing on the broader market. So we think it is not expected to have any implications for the market going forward, the broader market going forward. Also, a lot of questions I see about return expectations long term, but also specifically over the short term, going up to the election and so on and so forth. So I talked about the longer term. Let me just add a little bit more color to address those questions. See, on the short term, it is impossible to say what's going to happen in the next one. It's like, if you ask me whether it would rain on July 25th in Bombay or July 26th in Bombay, it's a guess. Sitting today in Feb, you can take a look at long time history and give some probability of how much it would go up, or how much it would rain or not rain. If you ask over the month of July whether it would rain in Bombay, you can guarantee, pretty much bet your house, that it would rain in July. So similar is with returns. Over the long-term time period, you can not guarantee, but you can have a lot higher confidence that the returns from the market would be the nominal GDP growth plus dividend yield that I talked about. Over any 6 to 12 months, it is impossible to say what's going to happen, because in 6 to 12 months, the market return is more a function of P multiple going up or down, which is impossible to predict. But over a long period of time, the returns are a function of earnings growth or cash flow growth of the company, which is in turn a function of the nominal GDP growth of the country. So that is the mathematical reason why in the short term, it is not possible to predict returns. Whereas in the long term, like I said, from Harshad Mehta scam till now, the multiple may have reduced by say 20-30%, but over a 33-year period or 30-year period, a 30% decline in PE multiple contributes just 1% hit to annualized return, ignoring the compounding effect. Yeah, because compounding effect would be even lower, less than 1%. But let's say 1% impact. The 12% return is driven by the earnings growth during this time. So over long term, earnings growth is more than 90% of the return that investors have seen. But in a particular year, like when the scam broke out, if multiple goes from 40 times to 20 times, that's a 50% hit to the market, to the return. And even if earnings were to grow 10%, instead of 100 to 50, you will be at 55, still 45% down, right? So in a year, P multiple could be anything, depending on variety of factors, and that would drive the short-term return. It is impossible to predict, not difficult. It is impossible to predict over the next 6 to 12 months what's going to happen. I mean, one can always weave a very articulate story to suggest that the market should go up or down, but that is all that it is, a story. There is no real value to such articulate rationales.
Sure, Prashant, thanks. I think quite a few questions were on that. I think there's another question between return expectation from the equity markets and gold in the next 5 years.
I saw that. Again, it's impossible to say. I would say over a long period of time. And Dipojal, if you can bring up that guaranteed returns versus, so this is something I've experienced in my personal life over the last 37 years since I've been involved in investing either for family or myself or professionally since 1985 in equity markets. Fixed deposit of SBI after tax has grown from, if 1 crore, there were many people crore-patis in 1985 as well, though I was a middle class boy back then. But my neighbors were all our landlords, actually. They were all crore-patis. Some of them invested only in debt or fixed deposit. 1 crore after tax would have grown to only 9 crores today, which is massive destruction of purchasing power. Because inflation itself has gone from 1 crore to 14 crores. And that is true almost universally globally. By investing in risk-free debt to sleep well at night, sleeping well at night does not come free of cost. There's a massive cost, because over time it erodes your purchasing power, it erodes real value. One doesn't realize, because in nominal terms you feel like you're earning 6%, 7% or whatever, but after inflation you're losing money. And that's been the case in most countries globally. So inflation, 1 crore would have become 14 crore. Gold, 1 crore has become 27 crores. Yes, gold has more than kept up with inflation. Yeah, but it's only 27. 1 crore would have been 27. Sensex in an ETF or Sensex as an index, if you had invested in, then 1 crore has become 176 crores. That's really what the compounding machine market has been, and I believe going forward would be as well, relative to gold and relative to fixed income and whatnot. Over any 12 months, 3 months, 3 years, 5 years, it is not possible to say. Yes, but 5 years is long enough time that the odds are quite high that equity market would outperform the gold. But you cannot be sure. Like from Harshad Mehta peak in 92 to 2003 bottom. So Harshad Mehta peak in 92 was 4,000 plus Sensex, and 2003 bottom of Sensex was at 2,800. Many people would have said, what, this market is useless. In 11 years, I'm below what I had invested in 92. Yeah, I'm getting out of here. Gold has given such great return during this time. Yeah, that would have been a terrible time to exit the market. Next 5 years, from 2003 to 2008, markets went up 7-fold. From 2,800, Sensex went to 21,000, more than 7-fold increase. So equity markets, it is a tremendous compounding machine, but it is uncertain when it would give you big returns, when it would take away some returns and all. It is the only person who is worse off than SBI fixed deposit, in my view, in the market, is one who keeps going in and out of the market. Many of them end up doing far worse than SBI fixed deposit. I personally, as a policy, never try to time the market. For the last 30, I have been fully invested at the peak of dot-com bubble in 2000, at the peak of the 2007 GFC crisis, but I've also been fully invested at the bottom. The worst ones were those who got out at bottom and then stepped back in 100% later. I mean, in COVID crisis, a lot of people got out in March, close to the bottom, and then kept complaining about the dichotomy in the market, as markets kept rallying despite dead bodies all around the world. Yeah. So all these uncertainties and all that this question is asking about, that has always been there. Market, global macro, you tell me when over the last at least 15, 16 years, the global macro environment has been certain. It's always been uncertain since Lehman Brothers crisis. It is fashionable to find uncertainty in the world. And there are more than enough highly paid economists and strategies who will find uncertainty in the world at all times, particularly, as I said, fashionable since 2008 Lehman crisis. So I don't believe that today is particularly more uncertain time than in the past, when you've seen stuff like COVID and Lehman crisis and other, I mean, in India, political uncertainty, right? Political in the sense, you don't know who's going to be elected and whatnot. That uncertainty is quite low right now, right? So the nature of uncertainty varies. Sometimes it's a pandemic. Sometimes it's Trump doing things that he did. Sometimes it's inflation. Sometimes it's war somewhere in the world, but it's always uncertain. But it always feels like right now is more uncertain than any other time. And I can guarantee you 3 years later, you'll all feel right now is 2025 and we are in 2026, you'll feel 2026 is more uncertain than any other time. But reality is it's always almost as uncertain. Yes, times like COVID, times like GFC, the uncertainty shoots up for a while, and that is reflected in the VIX index. If I see the VIX index now, it is not, any degree extraordinary level of uncertainty. So if you look at the VIX index, right now it is what, at 18.51 CBOE VIX index. In COVID times, it has shot up to nearly 100. Yeah, so I don't think this is one of the most uncertain times. There have been far more uncertain times than right now. And even if it is one of the most uncertain times, there's no answer to what you should do. Because COVID bottom of the market, which is when the VIX index shot up to actually 65, is what this is showing here. Sorry, 83, I correct myself. At that point, you would have said uncertainty is so high, let me switch to gold. And that would have been the worst time to switch to gold from equity markets. Gold's been probably flat since then, or flattish, whereas equity markets have done extremely well since then. So, I mean, we've had sessions before this and we've talked a lot about it. The lessons from COVID, if we were to go to that slide for a second, the biggest, a lot of the questions are pertaining to macro and all. So what were the lessons from 2020? We are nearly a 3-year anniversary, right? February 20 or so is when it started. So might not be a bad idea to, and if you're running out of time, maybe we can stop with a refresher on what were the lessons from COVID. The biggest, I mean, in one line, and we wrote a newsletter on this, and I'll request anyone who's not read that newsletter to take 10 minutes to read that newsletter. That is, to me, the most important lesson that of a lifetime that I learned, fortunately, very early on in the 80s, which is the futility of predicting investment returns based on macroeconomic worries and events. I just would read it again. The futility of predicting investment returns based on macroeconomic worries and events. And we've then split it into 3 lessons. The usual perennial worries of well-known, unknown variety, like inflation, interest rates, economic growth, and all are a colossal waste of time. Because all of those were disastrous in the year 2020, and yet markets provided supreme returns, one of the best returns. Lesson 2, nobody has a crystal ball to forecast unknown risks like Russia, Ukraine, pandemic, and all that. But even if you were bestowed with perfect prior knowledge of what's going to happen in the real world with the pandemic, market implication remained completely unpredictable. If you knew in February 2020, these many people would die around the world, these many lockdowns, these many infections and whatnot, and the COVID zero and all that, would have sold out and gone into gold at that time. So in a way, people were saved by not having the perfect knowledge of what's going to happen in the world. And then finally, lesson which summarizes all this is investment decisions that are, instead of bottom-up analysis driven by macro considerations, are fraught with very high risk of substantial, absolute, and relative losses, which we've seen in every crisis, people bailing out because of the media headlines that all look very dangerous in such time periods. And then getting in much later. So I'll just pause there and see, Vivek, it's been close to 1 hour, 25 minutes. Do you want to continue, or?
Yeah, maybe one final question, Prashant, which is there, and that's on the debate of active versus passive, and if active analysts can continue to generate alpha in India, and then we can close session, Prashant.
Certainly. So I have had the somewhat unique amongst India managers opportunity to have managed US funds as well for investors when I was living in US for 11 years, and developed market funds as well, and EM funds as well and all. So see, US is the ultimate in market efficiency. It is still possible to generate alpha in US, but if you can generate 1 or 2% alpha, as we were talking in case of Warren Buffett, if you can generate 1 or 2% alpha, you'll be in top decile, top quintile over time. Yeah. In India, fortunately, the markets are not so efficient. They would gradually become more and more efficient as more and more people invest, and there are more and more fund management houses and PMSs and all. They would become more and more efficient over time. But this is an evolutionary phenomena, not revolutionary or sudden step function phenomena. So maybe over the last, like if you look at, my own, and this is all public on Bloomberg and all the data is available, 10 years at Goldman generated somewhere on a gross of fee basis, more than 800 basis points, somewhere like 850 basis points or something of alpha. That was the time period between 2007 to 2017. Now it is possible that the following 10 years or next 10 years, the alpha opportunity inefficiency in the market is reduced. But has it gone to low single digit or zero? I don't think so. I think the opportunity still exists of mid to high single digit alpha generation. It doesn't come in straight line, but you'll see over the last 6 years, over the last 5.5 years, we have generated 5.5 to 6% gross alpha, as the chart, if I remember correctly, is showing. And that puts us amongst the top. So it is maybe the top decile level of alpha, maybe in India, 3 to 4%. If you are able to generate, or 4 to 5%, you would be in top decile in India. That number is maybe 1 to 2% in the US. Because of greater inefficiency in India, you can generate more, and every percentage point over time obviously adds up to very large figures. So I often joke and say, when I'm asked this question by investors globally, that passive investing is possibly a career risk for my great grandkids generation, not for our generation. At least as of now, that's my belief, because this is a very gradual evolutionary process. US has had institutional money management at scale for last 100 years nearly. India has started just in the 90s. It's 25 to 30 years old only. So thank you all for taking the time. Much appreciate. I know it's fairly late in the evening in India as well on Thursday. You all enjoy your evening, and happy investing. Thank you all on behalf of WhiteOak.
Thank you.